Welcome back. Now, despite a 5% decline in gold output, DRDGold has managed to deliver a 14% rise in annual revenue and a 4% lift in annual headline earnings per share, bolstered by a 20% increase in the average gold price. Joining us for a closer assessment of this performance is company CEO Niel Pretorius. Niel, a pleasure. Good afternoon.
Good afternoon.
All right, Niel, it looks like all the key metrics are in the green. So let's touch on that, maybe looking at the upper end of the income statement there with revenues and profits. How are you feeling about that? And are you satisfied with the value that you've managed to eke out?
I think we finished the year happy with where we are, but perhaps not entirely happy with how we got there. We did leave some value behind. We didn't quite get to the volume profile that we had targeted at the beginning of the year. So we were 16% short of our volume target, but we did manage to achieve 93% of our gold output target. So, yeah, a bit of a mixed bag. Good results, good gold price. We managed to take advantage of that. But you do feel as though it could have been a tiny bit better.
Let's talk about some of those misses, Niel, that you're not satisfied with, maybe understanding the cause of those missed targets and how we'll remedy them in the future.
Certainly. So our main operation in terms of volume throughput is Ergo, which we acquired around about 2007 and then capitalized. It was initially an operation with a 12-year life, and most of the core sites that we were mining, the dumps that we were mining, started running out about 2.5 years ago, and they needed replacement. And I think the combination perhaps of COVID and some under-resourcing, some understaffing, it led to delays by one of the licensing authorities, one of the regulators, which pushed out some of those timelines by between 6 and 9 months. So because of that, we didn't quite achieve the volume throughput, and we had to scratch around for tons, not following our usual method of mining. Typically, we mine with hydrojets, high-pressure hydrojets. We had to do quite a bit of mechanical mining here with lifting of material and hauling of material with trucks, and that added to the cost profile. Thankfully, that's all behind us now, so we're in a much better position. We can now enter the new financial year with all 5 of those sites fully commissioned and up and running, and we seem to have hit steady state there as well. So the volume throughput prospects for the remainder of this calendar year and the rest of this financial year certainly look quite a bit better than what they were 12 months ago. However, the gold price came through for us. So as I said, we did achieve 93% of our gold output target, and we were in a position to take full advantage of that gold price. Those cash flows came in handy because we just finished our solar farm. It's just under a 3 billion rand project, which is paid for, and it's up and running. It's being systematically introduced into the circuit. So that's also going to assist quite a lot this year in terms of unit costs.
We do see, though, that you did manage to achieve a cost margin, or sustaining cost margin of 24%. What was the ideal number for you there, Niel?
Well, it's hard to say. I mean, it's a bit lower than what we had targeted, considering where the gold price ended. We were budgeting for a gold price barely above R1 million, and then towards the end of the year, it was pushing against 1.3 million, 1.35 million per kilo. So it would have made quite a big difference in terms of free cash flow. But we were cash flush. We started the year with 2.5 billion rand in the bank, and most of that went into the solar farm. We finished with about 500 million left, which is going to go towards some of the other capital projects. And that's really now all systems going to position ourselves for what we believe is the next phase for DRD, both of its operations. And that is to lift the current output to 3 million tons a month, and to take gold production from 5 tons per year to just over 6 tons per year. And that we're targeting with effect from the 28th financial year. So in other words, July 2027.
Okay. I also want to touch on the balance sheet there and how that's faring, maybe looking at some of the debt that sits in the books at this time, Niel, and also maybe the state of the balance sheet and how it does support these growth initiatives that you're putting in place.
Yeah, absolutely. So we did manage to install what we refer to tongue-in-cheek as our 3 billion rand prepaid facility in terms of electricity. That's up and running at Ergo. We managed to do that without incurring any debt. And as I say, we finished the financial year with 500 million in the bank. We don't have any interest-bearing debt at this stage. Going forward, though, in order to set the business up for that next phase does require quite a bit of capital in terms of building new tailing storage facilities and also doubling the size of one of our plants, the one out in the far west rand in Carletonville. And so we did take out a facility. It's a revolver, and depending on where the gold price goes, we may have to dip into that at some point. If the gold price stays where it is, and if we do achieve our volume targets, and as I say, we're better positioned now to actually do that than what we were a year ago, it's going to be relatively modest debt necessary to see this project through.
With that said, let's take a look ahead. We are speaking about a bit of a shift in the macros. Interest rates are possibly falling, but we are still seeing panic, uncertainty around the world. That's often great for gold. Niel, how are we taking stock of the global macroeconomic environment and how that might play into DRDGold's future?
Yeah. But I think the West has been in denial for a while now. It's been ignoring the fundamentals, and as a consequence, they've been selling a lot of gold. And China and its friends have been saying, well, thank you very much. What you don't want, we'll take. And they've been accumulating gold at the rate of knots. Now that the sentiment's changing, the West is coming in, they're sort of coming in at a gold price that's rebased quite substantially because of buying patterns on the other side of the globe. So yeah, the rest of the world is going to have to pay more for its gold, unfortunately, this time around. They're not solely responsible for the cycles and the dynamics in the gold price. Typically, when the interest rates in the United States go down, there is an increase in buying and accumulation also in the United States and in the West. So the fundamentals are certainly looking favorable. However, I think a lot of the sentiment at this stage is as a consequence of accumulation that's been taking place in the East. And although they still have a very, very small percentage of total, let's say, total currency value covered in terms of gold, less than 1%. And if they are investing in gold as some sort of a de-dollarization initiative, there's still a lot of buying remaining. So we'll see. We're planning for the current gold price, maybe a little bit lower than what it is. But if it does go higher, it's happy days. So we'll take it.
Well, Niel, it's been a pleasure hearing from you. Thank you so much for taking us through this performance this afternoon. That was DRDGold CEO Niel Pretorius.